All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Tuesday, everybody. Happy July. Today's July 1st, 2025. And our top story this morning is the auto market. And well, earlier this year, the auto market, things were looking okay. There was plenty of stress among the automakers. Their stocks weren't doing so well, but cars were moving. There was a lot of worries about tariffs and tariff price hikes, and we did get some auto tariffs, around 20% on imported vehicles. And that was driving some people in the first quarter of the year to move forward some of their demand for new vehicles. Well, we got some data yesterday from J.D. Power that says that is over, and it's over big. New auto sales in the United States fell to just 15 million cars on an annualized rate for the month of June. That is down sharply from 17.6 million that we hit in April. It's the lowest level in a year. And look, this is being accompanied by several other headlines in the auto space this morning. Things among the car makers are not looking so good. We've got tariff fears are yielding to affordability concerns. People, it's the same problem we have with houses. People just cannot afford new cars. The combination of ridiculously high prices, cars that have been made needlessly complex and have all kinds of fancy systems added to them, when really people just want transportation. They want to be able to get to work and back. They want a reliable vehicle. But no, we can't get that. We have to add another sensor. We have to add another system that nobody's really asking for, driving up the price of these vehicles. And look, this isn't like housing, where we have a housing market is being handcuffed or handicapped also by affordability problems. In housing, people with the golden handcuffs can just sit on their house. They can sit with that mortgage they refinanced in 2020 at next to nothing percent and just ride out a bad market. You can't do that in the automotive sector because you've got a rapidly depreciating asset here. Cars break down. They age rapidly. And so rather than give the market what they want, we've got the auto industry is saying we're probably going to be seeing production cutbacks, capacity reductions. Instead of selling cars people can afford, they're just going to make fewer cars. And I guess only the rich will have cars, which is kind of the whole thing that the WEFers have been pushing for years anyway, because climate, look, that's not a good sign for the jobs market. We've got labor data coming out later this week. Later on today, we've got the JOLTS report is coming out. And then we got non-farm payrolls on Thursday because of the shortened week. Normally that would come out on Friday, but we'll get that on Thursday this week. And we've already seen some weakening in the labor market. I think we will continue to see weakening in the labor market, even if we get another stupid headline like more jobs added than expected, as long as you ignore the granularity in the household survey and as long as you ignore the fact that we downwardly revised all those magnificent jobs from prior months. The labor market is weakening, and we haven't even really seen auto contributing to that yet. So autos could be a big problem for some of that later labor department, maybe not this month, but in future months. Now, we've got some other headlines in the auto sector this morning. We've got Renault is coming out, and they are taking an $11 billion loss on their stake in Nissan. And we've had a lot of Nissan headlines this year. Nissan has already cut production. They've shut down several factories. There was an article not too long ago about how Nissan was asking some of their vendors, hey, can we pay you guys back in 6 months? We got this whole liquidity thing going on here. We're trying to fix that. So Nissan has kind of been at the forefront of this struggle in the auto sector. Renault taking a big hit on that stake this morning. Meanwhile, you've got Jaguar is out there saying, hey, Nissan, hold my Bud Light. OMFG, Jaguar has put on a crash course in brand destruction. In a shocking turn of events, it turns out that there just weren't that many art teachers who could afford a Jaguar. And so that big gamble they took with their androgynous, bright-colored, minimalist ad campaign late last fall, wait till you see the numbers from Jaguar. Good God, they have totally destroyed that brand. And we've got BYD, another auto story this morning, the Chinese EV maker. They continue to see their sales increase, up 10% year over year after another month of steep discounts. Now, that's a story as Western automakers have seen their sales decline. We've seen BYD's sales rise, but we're also starting to see a lot of bickering, a lot of back and forth starting in China over this price war. And we've got another story in China this morning. Xi Jinping sounds kind of pissed. And to be honest with you, he's a little scary. We got this article in Bloomberg this morning where Xi Jinping is at this financial summit, and he's talking about trying to rein in intense competition and build a unified market. And I'm just sitting here saying, what in the Karl Marx are you talking about? It sounds an awful lot like China is about to start nationalizing things, implementing price controls at the national level. I don't know where they're going with this, but it almost sounds a little bit like a wartime economy. I'm not going to lie, what China is gearing up for. So some scary sound bites coming from Xi Jinping, Emperor Pooh over there across the pond. And even as that's going on, we have the circus of American politics continuing this morning. The feud between the Donald and the Elon is back on. They're fighting again over the big, beautiful bill. Tesla stock is down 6% ahead of the opening bell this morning because Elon is now out there threatening to support primary challengers for any Republican who votes to support the big, beautiful bill, which is a $5 trillion hike to the debt ceiling. Remember, guys, you campaigned on spending cuts. Anybody want to cut spending? Any of you guys in the back? We only make stupid speeches about spending cuts. And then when we're in power, we do the same thing the other guy does. And then we're like, oh, don't worry. The Congressional Budget Office says 15 years from now, if you rub your tummy and tap your head at the same time, maybe we can cut spending once the debt reaches, $100 trillion. Look, the spending is getting worse. It's not getting better. We had this whole big, ridiculous exercise at the beginning of the year. We called it the Department of Government Efficiency. We found some freaking ridiculous examples of things the federal government was spending money on, and then we did nothing about it. And now we're trying to give the government a $5 trillion blank check. And Elon Musk took a lot of hit to his personal brand and his business enterprise to do that. He stuck his neck out there to try to restore some semblance of sanity to the fiscal situation in the government. And the government did squat about it. He's rightly pissed. And I'm pissed too. So I hope he challenges these Republicans who do nothing about spending. I don't care about the big, beautiful bill. I don't care that the Donald needs a W. I don't care about that. I want the freaking debt to stop growing at $2 trillion a year. And right now, the Donald has not done a damn thing about that like he promised to do. And I talked a lot of shit about the last guy that was in charge, and I'm going to do it to this guy too. Sorry if that ruffles any feathers this morning. Cut the freaking spending. Meanwhile, we've got another story from Amazon, who will soon have more robots than people. That's an interesting trend that's not slowing down. And what can a pallet company show us about the dangers of private credit and private equity? This is an interesting story I found hiding way below the fold in Bloomberg this morning. We have got a lot to talk about once again, so why don't we shrink my big melon of a head and let's see what is going on in markets this morning. And hey, don't forget that like button and that subscribe button for the algorithm if you're new here, because we do this every day. So come on back and have your coffee with the melon heads, because we do this every morning. The S&P right now is down a modest 16 points, about 0.25% lower ahead of the opening bell. The Dow is down 29 points, almost 30 points, 0.07% lower, essentially unchanged for the day. And the NASDAQ is off by about 1/3%, down by 76 points here. So we got all three indexes are in the red, but not by that much. And considering that we've made new highs a few days in a row here, that's not too surprising. Meanwhile, the dollar continues to weaken, almost certainly because of the ridiculous scenario playing out in D.C. right now. The Dixie is at 96.62, down another 16 basis points this morning. The weaker dollar continues its decline. And once again, not a lot of movement going on in the bond market. The bond market has been unusually quiet as the dollar has been weakening here. We got the 30-year Treasury, 4.769. That's down by about 0.5 point. The 10-year is actually up by 3 points and change here at 4.235%. The 2-year, meanwhile, is at 3.736. That's up by 1.5 points. And the 1 month is higher by 1 point and change at 4.244. And we've got a lot of green in the commodity space this morning, starting with gold, which is catching a bid here, up $45. Spot gold is at $3,348. That's higher by about 1.4% this morning. I'm sure the situation in D.C. is contributing to that rise in gold here. And gold has had a little bit of a pullback over the last couple of days after briefly touching 3,500. Let's just look at the long-term gold chart for just a second, shall we? Look, we flirted with that 3,500 level here back, what was that, at the end of April, and then we were briefly above 3,400 a few times since then. and we pulled back a little bit over the last week or so. I suspect we're going to be back above 3,400 in pretty short order here. Now, meanwhile, spot silver, this is kind of interesting. We've got spot silvers higher by 17 cents or about 0.5%, $36.28. But look at the July futures, that front month contract. July futures for silver are at 36.17. That's making almost double the move here, about 32 cents higher. So that exchange for physical premium is blowing out a little bit here this morning. We are about to see the front month contract roll over to the next one. So a little bit of backwardation going on here as the front month is trading at I guess it's this, I'm sorry, spot is a little bit more expensive than the front month. Unusual to see that. Let's just put it that way, guys. Not sure what's going on there. When this futures contract rolls over to the following month, we'll see what that is telling us. But for now, a little bit of a shortage possibly developing in silver as people are being offered a premium to roll over. Copper, meanwhile, higher by 2.5%. Platinum is higher by 2.1% this morning. That's another one that's kind of taken a beating over the last couple of days, now catching a bounce. Palladium is higher by 2.8%. And oil is a little bit higher here as well, higher by 0.7%, $65.57. Now, we got an interesting article from the Saudis this morning. Saudi crude shipments soar as OPEC plus leader chases market share. This is kind of interesting. Saudi Arabia is exporting crude at the fastest rate in over a year as the OPEC plus leader presses on with a strategy to recoup its share of global oil markets. The kingdom bolstered crude exports by 441,000 barrels a day, or about 7% this month, to 6.36 million barrels a day, according to preliminary analysis of tanker tracking data compiled by Bloomberg. The surge comes as OPEC Plus alliance speeds up plans to revive oil production, offering relief for consumers. It shows that shipments through the Persian Gulf and its critical choke point, the Strait of Hormuz, remain unimpeded despite consequences stemming from the conflict between Israel and Iran, including electronic interference of regional shipping. The development may also flick at what's ahead. Saudi exports are flooding out even faster than the OPEC Plus deal implies, at a time when peak domestic demand for air conditioning normally keeps oil supplies close to home. With the coalition contemplating further increases to output, Riyadh could potentially push out a greater portion of supplies once summer passes. So we got the Saudis are giving the Donald what he wants. They're pumping more oil here. One more stop here in the commodities board. We've got Bitcoin's a little bit lower this morning, down by about $600, $106,577 as priced on Coinbase, down from yesterday, but still in this band we've been trading in for a couple of weeks. All right, let's talk about some of these car stories this morning. Car sales hit a wall as tariff-induced shopping spree subsides. The springtime surge in U.S. auto sales landed with a thud last month, setting up a slowdown in the months ahead as car makers digest President Trump's tariffs on auto imports and consumers find fewer deals. Shoppers rushed to showrooms as beating tariff-induced price increases became a motivation to buy, pushing up second quarter sales an estimated 2.5% from the prior year period, according to industry researcher J.D. Power. That moment has subsided. The annual automotive selling rate likely fell to 15 million in June. That's the slowest pace in the last 12 months, down from 17.6 million in April as consumers grow cautious about big ticket purchases over worries about the economy. With already higher car prices expected to rise further as automakers manage billions of dollars in tariff costs, it may only get worse from here. The party is over, said Jonathan Smoke, chief economist for researcher Cox Automotive, in an interview. It's clearly slowing. It's because of affordability getting worse and forcing what we think will be production declines to keep supply in balance. And that is a problem there. That last part, we think will be production declines to keep supply in balance. Why make cars that the average person can afford, cars that people want, when you can lay off your staff and make fewer cars so only rich people can drive? Well, that's not good news for the job market here. And the automakers, we've already seen that, right? We've seen Nissan has been cutting their production, shutting down factories. I don't see anybody really investing any money in a base model that the average person can afford on the average salary. I see people adding more and more complex crap to their cars and then making fewer of them, driving the prices higher. And according to this guy from Cox Automotive, that's probably going to continue. And that's resulting in headlines like this: Renault to report $11 billion loss on Nissan stake in the first half. That is a big chunk of change lost by Renault here. Renault will book a one-off loss of 9.5 billion euros or $11 billion on its stake in Nissan Motor, the French car maker said on Tuesday, writing down its years-long investment in its Japanese partner that is battling slumping sales. The move is a further loosening of ties between the companies after a 2-decade-old alliance, with Renault gradually lowering its stake in Nissan and shifting largely to collaboration in specific manufacturing progress. And if you think that $11 billion loss for Nissan is bad, take a look at this story. This is just downright comical. This one in the Financial Express this morning. How Jaguar's rebranding gamble triggered a 98% collapse in sales. Well, the good news is they still got 2% of those sales going strong. So congratulations, Jaguar, on a successful rebrand. Jaguar's rebrand was striking in its departure from the familiar cues that had defined the brand for decades. The iconic leaping Jaguar logo was dropped in favor of a minimalist nameplate. The advertising campaign showcased bright, abstract visuals and models and stylized conceptual settings. Slogans like "copy nothing" and "delete ordinary" replaced references to cars, performance, or engineering. In fact, the advertisement featured no vehicles at all. Way to run an ad that doesn't even show your product. That's a bold strategy, Cotton. Let's see how it plays out for him. For decades, Jaguar stood for a blend of British engineering, performance, and luxury, an identity that helped that brand build loyalty among customers who valued refinement and heritage. But in its attempt to reinvent itself for a new era, Jaguar now finds itself facing one of the most severe sales declines in the European automotive market. Look at this number. In April of 2025, the company registered 49 vehicles in Europe, a 97.5% drop from 1,961 units sold during the same month the previous year. That is not a typo, guys. 49 cars in the whole month of April on the whole freaking continent of Europe. Now, look, Jaguar, a luxury brand, probably would have seen a little bit of a sales decline, just like every other automaker has seen a little bit of a sales decline. But 49 vehicles? Okay, well, congratulations, Jaguar. You are now, I don't know, you're now in the running for the worst rebrand ever. I think Bud Light probably still takes the cake on that one, but you're a close second here. Not exactly a title you want to be chasing. Meanwhile, BYD is doing the opposite. BYD, they're seeing their sales increase. BYD June sales inch up 10% after a month of heavy price discounts. Those are heavy price discounts that have gotten the company in a little bit of trouble with their CCP overlords. BYD registered its best month for car sales this year in June after slashing prices across its range in a move that drew criticism from government and authorities and industry groups. The Chinese car-making juggernaut sold 377,628 vehicles last month. That's slightly higher than Jaguar's 49, including 206,884 passenger battery electric cars. That was up 10% from a year earlier, helping to push first-half volumes to 2.1 million units, according to a statement on Tuesday. Rival Geely Automotive, meanwhile, sold more than 193,000 cars in June, a 59% year-on-year increase. The showing prompted Geely to raise its delivery target for 2025 by 11% to 3 million. BYD's discounting of as much as 34% across some models in late May may not have resulted in a sales bump it hoped for, and has certainly come with other costs. Data released by JATO Dynamics indicated that Chinese automakers almost matched Tesla's European registrations in May, building on its initial outperformance of the U.S. rival in April. It nearly quadrupled European sales in the first 4 months of 2025, figures from researcher Dataforce show. Pressured by regulators, BYD has ended some discounts in China and joined a collective industry pledge to standardize bill payments for suppliers to 60 days as authorities scrutinize the use of supply chain financing as a form of debt. Now, that last paragraph is kind of telling there. We talked about this one a few weeks ago in the live stream. BYD is getting in trouble because they're not paying their suppliers. It's real easy to sell cars when you don't have to pay for the parts that you put in them. And of course, that's causing problems upstream. Those suppliers are starting to go bankrupt, starting to lay people off. And so the Chinese government has gotten involved in saying, you guys got to cut this price war out. You got to start paying people off. And if you can't make a car at a profit, then just make fewer cars. And that's kind of leading into this one that my moderator Mish found this morning. Guys, this story's kind of a little spooky. I'm not going to lie. China vows to rein in intense competition and build a unified market. And man, I tell you, Lenin, Marx, they would be awful proud at this headline here. China's top leadership has pledged to curb aggressive price competition among businesses, aiming to accelerate efforts toward a unified national market to help boost domestic demand. And if that sounds like price controls to you, then congratulations, you're paying attention, because that really sounds like price controls. But this is price controls in an upward direction. I'm not talking about price controls to fight inflation. These are price controls to fight deflation going on in China. Officials at a high-level economic meeting chaired by President Xi Jinping said they would crack down on disorderly, low-price competition and phase out outdated industrial capacity, Xinhua news agency reported on Tuesday. So China's talking about shutting down old factories, limiting supply, pushing prices higher, cracking down on disorderly, low-price competition. In other words, disappearing executives for companies who cut prices. China's trying to keep their prices higher here. They're trying to fight this deflation problem we've been talking about. For years, Beijing has sought to dismantle local protectionist barriers in hopes of spurring consumption and domestic demand. With global trade tensions rising, that mission has taken on greater urgency. The renewed focus on curbing excessive competition and overcapacity suggests top leaders are concerned about the deflationary pressures weighing on the economy. To build a more integrated and efficient domestic market, China plans to standardize rules and infrastructure, align government practices, and unify markets for labor, land, capital, and other inputs. Holy price controls, Batman, what are they doing over there? Officials also called for the regulation of local investment promotion efforts and strengthening disclosure of related information. The fiscal system will be improved to support the push. Look, the government is just taking an increasingly heavy-handed approach here at reining in this deflation problem, artificially keeping prices higher. It's probably not going to work, but we'll see how that works out for them. And meanwhile, the political circus in the United States continues. Tesla stock falls as the Musk-Trump ceasefire is broken. What happened in round one? Well, round one didn't go so well for either party. President Donald Trump and Tesla CEO Elon Musk resumed their war of words as the electric vehicle maker stock slumped in pre-market trade on Tuesday. The Tesla CEO heavily criticized the one big beautiful bill that's working its way through the U.S. Senate, and the president retaliated once again by threatening to remove subsidies on Musk's companies and cancel contract for Tesla and SpaceX. As Musk's only listed vehicle, Tesla is once again vulnerable to the brickbats and threats of a high-profile political spat played out online. Somebody want to tell me what a brickbat is? I'd love to hear that. The dormant phase in the Musk-Trump fracas ended when, in a series of posts on X, social media service he owns, Musk attacked senators supporting the proposed spending bill that he believes will add $5 trillion to the deficit. He warned every member of Congress who campaigned on reducing government spending will lose their primary next year if it's the last thing I do on earth. Trump's retaliatory postings on Truth Social in the early hours of Tuesday articulated a direct threat to Tesla, suggesting that the Department of Government Efficiency, which was effectively run by Musk, should take a good hard look at the subsidies offered to Musk's companies, and that he was strongly against the EV mandate. And by the way, Elon Musk has already come out against these EV subsidies. That was one of the things that Doge recommended. And I was saying from day one that Doge should be taking a hard look at Musk's contracts. They should have appointed an independent member for the sole purpose of looking at Musk's contracts, but that never happened. That would have been one way to add some legitimacy to the effort, but I digress. Here's what Elon Musk posted yesterday on X. Pretty strong words here, saying anyone who campaigned on the promise of reducing spending but continues to vote on the biggest debt ceiling increase in history will see their face on this poster in the primary next year. Of course, the poster says, liar, voted to increase America's debt by $5 trillion. That $5 trillion number, that is the amount they are threatening to raise the debt ceiling by. Oh, and by the way, that $5 trillion might get us just past the midterms. You guys want to cut some spending? I don't know. Anybody out there? I mean, y'all campaigned on it. Just throwing it out there. I mean, look, this is what happens when you campaign on spending cuts and then you don't cut spending. You end up with headlines like this. Now, Elon is once again taking a pretty big hit to his personal wealth in order to do this. Look at Tesla stock down 6.2% ahead of the opening bell here this morning, $298 and a couple of cents here, down almost $20. Year to date, Tesla stock is down 21.3% on basically Elon's ventures into politics. And by the way, by threatening to primary people, look, Elon is almost threatening to start his own political party here. I don't know if that's really where he's going with this. But sooner or later, the U.S. has to address the spending problem. And until they do, none of us owns enough gold. That's all I can tell you guys. I like the shiny. That's why I keep my little America flag bar right here for just such an occasion. Meanwhile, Amazon is on the cusp of using more robots than humans in its warehouse. The e-commerce giant now counts more than 1 million of the machines at its facilities, and there's a little robot moving packages around there. The automation of Amazon facilities is approaching a new milestone. There will soon be as many robots as humans. The e-commerce giant has spent years automating tasks previously done by humans in its facilities, has deployed more than 1 million robots in those workplaces, Amazon said. That is the most it has ever had, and near the count of human workers at the facilities. Company warehouses buzz with metallic arms plucking items from shelves and wheeled droids that motor around the floors, ferrying goods for packaging. In other corners, automated systems help sort the items, with other robots assisting in packaging for shipment. One of Amazon's newer robots, called Vulcan, has a sense of touch that enables it to pick items from numerous shelves. Amazon has taken recent steps to connect its robots to its order fulfillment processes so the machines can work in tandem with each other and with humans. They're one step closer to that realization of the full integration of robotics, said Ruben Scriven, research manager at Interact Analysis, a robotics consulting firm. Now, some 75% of Amazon's global deliveries are assisted in some way by robotics, the company said. The growing automation has helped Amazon improve productivity while easing pressure on the company to solve problems such as heavy staff turnover at its fulfillment center. And yeah, I guess that's one way to solve your staff turnover problem, is by not having staff. I guess that's one way to get there. Look, Amazon is doing what the auto industry has refused to do, what the shipping industry has refused to do, right? Auto industries, there's been a lot of back and forth about automation displacing humans, and they fought that for years. One of the major factors in the longshoreman strike last year was the longshoremen didn't want automation at U.S. ports, which is basically exactly this, just with bigger boxes made of metal instead of paper. So Amazon has no such union problems, and they are full speed ahead on automation and all the good and the bad that comes along with that for people. Meanwhile, one more I want to talk about this morning, guys. And again, I've been sounding the alarm on private credit and private equity for a while here. And I saw this one in Bloomberg this morning. This was actually dated yesterday afternoon. Private lenders pitch restructuring for a stressed pallet company. Now, the first thing I want to say is a pallet company here. That's shipping materials. If the pallet company is in trouble, that means the companies that put the stuff on the pallets, they're probably not doing so well either. That's not the main reason why I draw attention to this. Private lenders have proposed a potential debt restructuring for 4840 Solutions, less than a year after Summit Partners acquired a majority stake in the pallet management company, according to people with knowledge of the matter. The company's debt includes around $1.75 billion of private credit, said the people, who asked not to be identified, of course. The lenders include Antares Capital, KKR, and BlackRock, as some of the biggest private equity firms, providing the financing in a recapitalization deal in October, the people said. The $1.7 trillion private credit industry has started to see more signs of stress as companies grapple with persistently high interest rates and a weakening consumer. Investors are eyeing how the asset class would handle a potential downturn, as the market has not yet been tested by one after growing rapidly in recent years. For KKR Capital, a business development company jointly managed by KKR and FSS Investments, marked down the value of 4840 loan to 76 cents on the dollar in the first quarter, according to a May regulatory filing. So right there, you can see this private debt that went to this pallet company. It's already trading at 76 cents on the dollar. This is the kind of crap that BlackRock and all these other firms are trying to democratize, try to make available to the average retail investor. So here it is, taking a 24% hit just a year after the debt was issued. But that's not even the main part here. As of March 31st, the company was paying the majority of the interest on its debt, priced at 6 percentage points over the base rate, in kind, according to regulatory filings. Payment in kind deals allow borrowers to defer making cash interest payments, typically until maturity. So what's going on here is, since they made this deal, since they borrowed this $1.75 trillion, they have not paid any interest on that debt. What they've done is they've taken the interest and they've just added it to the principal. It's a lot like forbearance. They call this payment in kind, or PIK. And it's one of the ways that the private credit and the private equity industry has been avoiding price discovery for so long. Now, here it is. It's not even working here. They haven't even been making their payments. They've just been tacking it on to the end of the bill. And still that debt is trading at just 76 cents on the dollar. So you can see this is really just a zombie company here. These guys are not making any money. They're not making any payments on their debt. The debt is just getting bigger, and yet the value of that debt is going down because people know they can't pay it back. The October recapitalization deal also saw Summit Partners, which first invested in the company in 2022, take a majority stake at 48.40. So you got a private equity firm now owns most of this company. If the restructuring happens, 48.40 would join a growing list of companies that have restructured their private credit loans over the past year, with others including Alacrity Solution, Zips Car Wash, and Pluralsight Inc. So once again, guys, they're trying to sell all this crap to our retirements, and then look at what's actually happening to it. They're not making any payments on it. The value of it is going down. Just know what's in your 401k, guys. And when your guy calls you and says, hey, we have this exciting opportunity to hold private assets, ask him if any of this garbage is lurking in that fund. And I just want to say thank you very much to Mr. BTB Inc. Oh, I see we've LLC'd that name. He's gifted 5 Nobody Special Finance memberships. Well, thank you, Mr. Bagger, for gifting those 5 Nobody Special Finance memberships. Guys, if you got one of those, be sure and say thank you to Mr. BTB, a name which I shan't pronounce on the air since I don't want to get myself in trouble. Thank you, sir, for supporting the channel. And who else we got here? Ben and Breakfast, another B&B, but I don't mind saying this one. Thank you, Ben, for supporting the channel. He says, Autotech here. Privacy is also on the chopping block with new cars. I.e., if you aren't logged into your car profile like a smartphone, your navigation won't work. Yikes. Ask me why I drive 20-year-old cars. What was that movie? It was that stupid Michelle Obama movie that was out on Netflix. There was a scene not too long ago with a bunch of white Teslas all crashing into each other because their navigation systems had been hacked. Yeah, not surprising there. Any chance they get to track your behavior, track your movements, and then sell that information, they're going to do. I don't want to have to log in. I don't want to have to remember my password for my car. I have a key to my car for a reason. It's so I can start it. And then I don't want any of that other crap. And disabling navigation if you're not logged in, that's kind of backwards. It's just another one of the ways that they're overcomplicating vehicles, guys. We don't need all this crap. Just a simple A to B vehicle. Why is that not available on this market? I don't get it. Thank you, Ben and Breakfast, for the anecdata, sir. Scary times. What can I say? Robert is feeding the machine once again this morning. Thank you, Robert, for supporting the channel. Elon spent $200 million. Yikes. I don't want to read that out line. Somehow only his second worst investment. I'm here for it. Let the narcissists fight. Is that a little bit of a Godzilla reference? Let them fight. Yeah, I don't know about that other story. Don't really want to read that one on the air. His second worst investment, I don't know what his worst would be. I don't know, maybe Solar City. That one didn't go so well for him. He had to bail it out. But yeah, look, you got narcissists, egos fighting like Godzilla and King Kong. Look, I'm at the end of the day, Elon Musk is a businessman. I've always been on the fence about the guy. There's things about him I like. There's things about him I don't like. Right now, he's the only person in the freaking universe with any kind of clout, except maybe Rand Paul. We could throw Rand Paul in there. That's actually doing anything about the spending problem. Everybody is talking about it. He's the only one doing anything about it. Spending cuts sucks. Austerity sucks. Austerity is always something that happens in the other guy's yard. It doesn't happen in your yard. And so nobody's in favor of austerity when it affects them. But with a $2 trillion annual deficit resulting in, what are we, almost $37 trillion now in debt, we need austerity. We need it in everybody's yard. And it's going to suck and it's going to be painful. But the alternative is unthinkable. And we still remain pedal to the metal, steaming towards the alternative. It is what it is, guys. Thank you, Robert, for feeding the machine. Real Estate Mindset. What's going on with my buddy Travis? Thanks, Travis, for supporting the channel with the 777. He says, thank you for another great morning show. You are most welcome, Travis. And by the way, thank you for everything you are doing, taking on the man in Texas, fighting those property tax increases. I freaking love it, brother. Don't threaten me with a good time. Check out Real Estate Mindset. He is a fellow doomer like me. And T-Spin, there's a name I haven't heard in a while. Hey, T-Spin, welcome back, sir. He says, thank you, Jack, for the daily updates. I've only missed a couple of shows since your rant on Twitter when you were nobody special. Well, thank you very much. I remain nobody special. I am perfectly at home and comfortable in my mediocrity. Hence, I wear it on my sleeve. Thank you, T-Spin, for the support of the channel and the kind words and for being with us since day one. And thank you, everybody, for having your coffee with the Melonheads this morning. Appreciate that. Don't forget that like button and that subscribe button as we log out and as we wrap up the show. Appreciate that very much. Thank you guys for the super chats, as well as you, my magnanimous Melonheads on Patreon and YouTube. You guys rock. Thank you so much. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody else, till next time, live small and dream big.